Hello and welcome. Today we're working on adjusting entries in accounting. These are entries we have to make at the end of the period to make sure the accounts are up to date. Now I'm in a series of an intermediate accounting, so this is chapter 3 in intermediate accounting, but this also would be helpful for anybody in financial accounting or accounting principles. Any accounting student that's trying to remember how to do or have a refresher on adjusting entries. Welcome, my name is Jeff, and I help you finally learn financial literacy. So let's get started with the adjusting entries. The first problem here has 3 little parts, and it doesn't have any calculations. We just need to make sure we know how to do the journal entries. So number 1, record at the end of the year accrued salaries of $500. So we're going to use an account salary expense. Okay, this is an expense, and we're going to use an account called salary payable. So salary expense, salary payable, we're going to debit 500 and credit 500. The expense goes up. We haven't paid this. It's an expense of this year, even though we're not paying that until next year. So salary expense, salary payable, an expense that goes on the income statement, and salary payable that goes on the balance sheet as a liability. The next one down is, what if we record the year end, the supplies that's used during the year of $800? So we have an account called supplies, so we're going to have supplies expense. I'm going to abbreviate the expense, and I'm going to credit the supplies account. So supplies expense is $800, and the supplies account goes down $800. Remember, you need to remember your debits and credits. Supplies is an asset that takes a debit to increase, so a debit increases, a credit would decrease it. Supplies expense is an expense account that takes a debit to increase. Number 3, record expiration of $300 of prepaid rent. Well, why would prepaid rent go away? Because we've used that rent, so therefore that's an asset, prepaid rent. So we're going to say rent expense, and we're going to credit the prepaid rent for $300. Now, what type of account is prepaid rent? Prepaid rent is an asset. As we use it up, it becomes an expense, and we use rent expense to show that. Rent expense is an expense account. All right, this next one down, we have several little more complicated adjusting entries. We're going to have some calculations. So here's our general rules for all these little problems. We're going to make the appropriate adjusting entry at December 31st, 2020. We're going to assume the cash was properly recorded in each original entry below. So everything's correct at first, and we're going to adjust the accounts at the end of the year. August 1st, Harris Company received $3,600 of rent in advance and credited unearned rent revenue. Okay, when you receive rent in advance, the proper way to do it would be to debit unearned rent revenue, which is a liability, that will become rent revenue, which is a revenue account. The lease was for a 3-year period, so 36 months if you prefer. Make the adjusting entry at December 31st. Assume cash was debited. So what was our original entry? Our original entry must have been, we receive cash, debit cash, we credit unearned rent revenue. All right, so what we have is we need to debit unearned rent revenue because it has expired, and we're going to credit rent revenue. So we're going to set up rent revenue. And what's the amount? What's the appropriate amount of this rent? Well, it's for 3 years. It's $3,600 a month, so $3,600 total. So let's just do some math. $3,600 divided by 36 months is $100 per month. So we're going to say, well, this is for August, September, October, November, December. That's 5 months. We're going to take 100 times the 5 months. So over the 5 months, we have earned, We are leasing to somebody. We own an asset that we've rented to somebody else. They're paying us money. They paid us $3,600 to rent that asset for 3 years. So we're going to earn $500. Even though we got paid at the very beginning, we got paid $3,600. It's not all revenue until the 3 years has elapsed, 1 month at a time. So unearned rent revenue is $500, and rent revenue, we've recognized rent revenue income of $500. Now, remember we received the cash August 1st, which is good, but we would owe that money back if they decide to not rent anymore. All right, the second part of this one, it says make the adjusting entry assuming the company had credited rent revenue instead of unearned rent. Okay, so let's go back and make sure we know what's going on here. This first one is we assume the very first entry was cash and unearned rent revenue. We're assuming that this entry was made, 3,600. Let me move over here, 3,600 and 3,600. We're assuming this entry was the original entry. What if the original entry was we credited rent revenue? Now, how does this change our problem? If it's rent revenue, now let's think about what we know. We've received $3,600. We received this right here, $3,600. We're the company that owns the asset that is leasing it out to somebody. They're paying us $3,600 over 3 years, or $100 a month. And so we recognize, hey, we haven't earned this yet. That's $3,600 in unearned rent revenue. We recognize revenue of $500. So how much unearned? What's the balance of unearned at the end of the year? Well, $3,600 minus the $500 is $3,100. So how do we make the adjustment? If everything is in rent revenue, $3,600, we only want to recognize $500. We're going to debit rent revenue for $3,100. This will make the balance $500, right? So $3,600 with a debit of $3,100, the balance will be $500. And we set up what? So we have rent revenue, and we need to recognize we have unearned rent revenue. So we set up the liability of $3,100, and we recognize the revenue of $500. So we're in the same place. We started in a different place, but we got to the same place with the adjusting entry. All right, so same facts, except somehow we made what looks like it to be an obvious error. Let's say instead of debiting cash and crediting rent revenue or unearned rent revenue, we credited repairs expense. Let's just say this is a mistake. Let's say sometimes on a computer you can select a drop down, rent revenue, the next one down is repairs expense. We're not being careful and we made a mistake. It happens. So what do we do if we made this error? Well, we still want $500 as rent revenue, $3,100 as unearned rent revenue, and we need to get rid of repairs expense, $3,600. So how do we do this? It's going to take three things. We're going to debit repairs expense for $3,600. We need to set up rent revenue for $500. And we need to set up for $3,100 the unearned rent revenue. So we have rent revenue is $500, unearned rent net revenue is $3,100. All right, the next problem talks about Harris borrowed $500,000 on June 1st on a 1-year note at 9%, interest and principal being due at the end of the 12 months. Make the December 31st adjusting entry. Assume interest rates are annual rates and are at simple interest. not compound interest. So to remember, simple interest is interest equals principal times rate times time. We abbreviate it as I equals PRT, principal times rate times time. So we'll do the math on this in just a second. All right, so the adjusting entry is we borrowed the money, we're going to repay the money all at the very end. So we need to set up interest expense and interest payable. Interest expense and interest payable. Now how much is it going to be? We're going to take the $500,000. Now this is not the way to do it in Excel. I'm just showing you. I'm typing it out like it's Word, right? Or like a word processing program. So 500,000 times 9%, so that's really 0.09, times how many months? Well, if we have it from all of June, July, August, September, October, November, December, that's 7 months. So we're going to use a fraction, 7 divided by 12. 12 months, 7 out of 12 months, so we only get to calculate a fraction of the annual interest rate the first 7 months. Then we'll have in 2021 January, February, March, April, May. That's 5 months. All right, so here's how you do the math in Excel. Obviously start with an equal sign, 500,000 times 0.09 times 7 divided by 12, and we get 26,250. 26,250 is our interest expense we have incurred. We're not going to pay it until June 1st, basically 2021, or May 30th, May 31st, June 2021. All right, the next one is same facts. Make the regular journal entry on June 1st. June 1st is the date, 2021, when both principal and interest are paid to the bank. Make the entry for Harris and the bank. We'll make the entry for Harris. We won't do the bank on this side. I'm going to delete this because I can. How about that? Make the entry for Harris. Now, what is the total interest that's going to be earned? The total interest that's going to be earned is going to be 500,000 times 9%. And if you want to do it, this doesn't make any sense, but you could do times 12 over 12, which reduces to 1, right, which is not important. So just 500,000 times 9%. What's the total interest that happens here? Well, it's going to be 500,000 times 0.09 should be 45,000. All right, so 45,000 is our answer. So if you're Harris, what are you going to pay? You're going to pay cash of you received 500,000. You're going to pay back 500,000 plus 45,000. So we're going to debit notes payable. We're going to debit interest expense. We're going to debit interest payable. And we're going to credit cash. Now we know that we're going to pay a total of 545,000. The 500,000 we have to repay that, and then we're paying 45,000 in interest. Our notes payable we know is 500,000. So what's our interest payable? Our interest payable was interest from 2020. That's that number. So how much is our interest expense for the 5 months? We could take 500,000 times 9% times 5/12, or we can back in to find that number. This is going to be the 545,000 minus the 500 minus the 26. It must be 18,750. If we took the 500,000 times 9% times 5 months, then that number apparently will be $18,750. All right, this next problem, we have on May 1st, Harris paid $4,800 for an insurance policy, for a 2-year insurance policy. They debited insurance expense. Now, let's think about this. We would recommend prepaid insurance would be the account and credit cash, and it is for $4,800. We think that should be the entry. However, what they did, they actually debited insurance expense. All right, regardless of that original entry, we need to make an adjusting entry. So May 1st to December 31st, we need to show how much insurance expense we have, how much prepaid insurance that we have. All right, we're going to figure out, we can do this for a month. $4,800 divided by 24 months, that's $200 a month. So we have all of May, June, July, August, September, October, November, December. So that's 8 months. 8 months. So we need to figure out, well, we're going to debit the prepaid insurance. So we need to debit prepaid insurance. I had to abbreviate it earlier. I'm going to write it out here. Well, what's the amount? And we're going to credit insurance expense. Well, $4,800. So it's $200. So we have, let's figure out the amount. $200 times 8 months. So $1,600 is what the expense should be. We've expensed all $4,800. So we need to back in and figure out the expense would be $4,800 minus $1,600. So it's apparently $3,200 is our insurance expense. So we're going to put in the asset $3,200. Now, this is a little bit tricky because if we made the entry to prepaid insurance, that's the asset, and then we use it up. So what we have is, what happened to the $4,800? Let me wipe this out here. What happened to the original $4,800? $4,800 is how much we paid. How much goes to prepaid insurance? And how much goes to insurance expense? Well, the expense is $1,600. That means the prepaid insurance, the asset that we have left, is $3,200. So this is 8 of the 24 months, and this is 16 of the 24 months. All right, so you might want to just work that out, run the math on it, make sure you're in great shape on that. I'm going to delete this. Okay, next one down. Harris had a balance of $600,000 in an account earning 5% per year. We have the asset, we're going to earn interest. The funds were invested on October 1st, and no interest had been added to the account as of December. And we're going to make the adjusting entry on December 31st. So we're going to set up an interest receivable and set up an interest revenue account. How much have we earned? This is going to be simple interest again. So it's $600,000 times 5%. How many months we're talking about? Well, it's October, November, December, so we're talking about 3 months. So 3 divided by 12. So how much interest have we earned? So 600,000 times the 0.05 times 3 divided by 12. So must be 7,500. That's how much we have earned. That's how much we will collect, but not until 2021. All right, next one down. Harris had net income before paying bonuses of $340,000 for the year 2020. The company had agreed to pay its officers their annual 12% bonuses, and the payments happen in February. So make the adjusting entry as of 2020. So this is 2020. No bonus has been paid yet, so what do? We're going to set up part of the compensation for this company is we have bonus expense and bonus payable. To give the officers an incentive to help grow the company and increase net income, we're giving them a pool of 12% of pre-tax, pre-bonus profit. So all we're going to do is take 340,000 times 12%. That's 480,000 is the bonus, and we're going to pay that apparently on February 1st. All right, the last little problem here, this is not really directly adjusting entries, but it is related to adjusting entries, and this is the cash method and the accrual method and switching back and forth. This is a topic in Intermediate Chapter 3, and you need to know how this works and just have a little simple problem. It deals with adjusting entries and changes to accounts. So I think it's just really good logic to make sure you understand. If you understand this, you really start to understand what's going on in accounting. All right, so let me move this over a little bit. Foster showed the following balances: ending accounts receivable, sales on the account, repairs expense, accounts payable, and beginning accounts receivable. So the question would be, hey, find cash collected on accounts receivable. What is cash collected on accounts receivable? Well, we don't need all this. Like repairs expense is kind of a red herring. You just don't need it. You can. One of the things you have to know is what you need and what you can ignore. That's important. Okay, so here's our format. You can write this down or memorize it and put in your notes, and this is always going to be how you find cash collected on accounts receivable. Now remember, our accounting system is the accrual system, the accrual system, and we're going to convert this to cash received from customers or cash collected on accounts receivable. Both of those mean the same thing. What did our customers pay us? So we're going to start with sales, and our sales are $300,000. Now, if we can have sales on account, that would be perfect, but sales $300,000 is fine. Plus or minus the change in accounts receivable. Okay, the change in accounts receivable. We need to find the beginning accounts receivable. Here we go, beginning accounts receivable and ending accounts receivable. So I'm going to put this on the little T account just so we kind of know. Our beginning accounts receivable is $31,000 and our ending is $42,000. Okay, accounts receivable is an asset. If you have accounts receivable, you have the right to collect money in the future, but you're not collecting it currently, right? Because they owe you the money, you haven't collected the money. So here's what we need to do. We need to figure out, is this $11,000 a positive number or a negative number? Because the accounts receivable go up, did we collect more cash or less cash? Well, actually, because we made a sale, let's just say that's one sale. We made a sale on account, so our sales go up, but our cash does not, and so therefore we need to subtract that out, so it's going to be negative $11,000. So how much is our cash received from customers? It's going to be $289,000. $289,000 is cash received from customers. Well, we can do this on the T account. We can do it here with this format. That's perfectly fine. Cash collected on accounts receivable or cash received from customers. We can do the same thing with the accounts receivable. You might want to work with the T account. That's fine. Well, what's our sales? Our sales on account, we debited $300,000. We debited $300,000, sales on account, debit accounts receivable, credit sales, right? Remember that transaction? All right, here's how you do this number. You got $31,000 at the very beginning and $42,000 at the end. You know you debited sales of $300,000. We're going to start with the 31 plus the 300,000 minus the 42,000, and we're left with, well, we must have collected 289,000 to make it all work out. All right, let's look at the Cameron problem. Let's say cash paid wages for the year is $180,000. The ending wages payable is $18,000. The beginning wages payable is $25,000. And land obviously is not going to be affected in this problem, so we can ignore that side of it. Wages payable, beginning wages payable is $25,000. It's a liability, so it's on the credit side. The ending wages payable is $18,000. Anytime we pay cash, we're going to debit wages payable and credit cash, so that's $180,000. And so how much is our wages payable? Our wages payable is going to be what? We're going to start with 18 minus the 25 plus the 180. We should get 173,000. Now let's think about, we can do this in an alternate way. We can think about the two journal entries. Let's say we set up wages expense and wages payable. We set up wages expense and wages payable. Let's say this is 173. And let's say we have wages payable and cash. We know we paid $180,000. And so this is, we know that our balance goes down 7. Wages payable is 173, but we pay off 180, so that means our wages payable goes from 25 down to 18. Okay, you got to think through it, see what you know, and solve for what you don't know. All right, the next one down, we just have a few more here. Muschamp paid the following balances. We have ending accounts receivable, sales on the account, and beginning accounts receivable. So we're going to do this. Let's set on the accounts receivable, it's an asset, so it takes the debit balance. Beginning accounts receivable is $78,000. Our ending accounts receivable is $56,000. And we have sales on the account. So we're going to debit accounts receivable for $455, and we'd credit sales. All right, so everything's on one side, the debit side here. Our sales are $455. Our change in accounts receivable is the difference between the 78 and the 56, which is $22,000. So we have to think, now is the $22,000 going to be a positive or a negative? Did having our accounts receivable from 78 go down to 56, did that mean we collect more cash or less cash? Well, we collected more cash because they paid it off and reduced the accounts receivable balance. So therefore, our cash collected on accounts receivable is $477,000. All right, the way this one works is we would take the 455, we'd add the 78 and subtract out the 56,000. We got 477,000. You can do this two different ways. All right, I think we have two more here. Yates, same kind of problem here. We're going to figure out cash paid for salaries. So salaries payable is a liability. We have beginning salaries payable 23,000. We have ending salaries payable of 29,000. And we know salary expense is going to be 245,000. So the salary expense is a debit. The salary payable is 245,000 on this side. The salary expense is 245, and we're going to add or subtract the change in salaries payable. All right, so the difference is for salary payables from 23 down up to 29,000. So 23 increasing to 29. So that 6,000, did that make our salaries payment go down, or did our salaries payment less than, or did it increase over the 245? So let's think about this. The expense they earned is 245. Have we paid them yet? Well, yes, except for 6,000. So we need to make this a negative 6,000. And so our cash paid for salaries is going to be a little bit less than, which is 239,000. So let's think through this. Let's start with the 23,000 plus the 245 minus the 29,000. So 239,000 must have been our cash payment for salaries payable. Salaries expense is 245. Our salary that we paid is 239. We owe them the extra 6,000 that they have accrued. All right, last little section here is we have one more, and we need to figure out cash paid to suppliers. Cash paid to suppliers. Now, we're going to say we need cost of goods sold, we need accounts payable, and we need inventory. So what's our cost of goods sold? Our cost of goods sold in this case is 290,000. Our change in accounts payable is going to be the difference in the 23 and the 20. So I'm going to put in 3,000, but let's think if it's positive or negative. Now, cash paid to suppliers. Our beginning accounts payable we owed to suppliers was 23,000. The ending accounts payable we owed to suppliers is 20,000. So we must have paid 3,000 to make that account go down. So that's going to be positive. We're talking about cash paid to suppliers. Change in inventory. It goes from 33,000 up to 37,000, an increase of 4. So 4,000 means we made more cash payments because we're buying more inventory. So therefore, our total is 297 is the cash paid to suppliers. This one is the one that has cost of goods sold, change in accounts payable, and change in inventory, plus or minus the change. It could be a positive 3,000 or a negative 3,000 or a positive 4,000 and or a negative 4,000. So there is how you do lots of adjusting entries, and then how we convert cash to accrual or accrual to cash. All right, thanks for watching.